Welcome to Young Money with Tracy Bissett, the advice show for young millionaires in the making. It's time for some $1 Million Straight Talk with Tracy, President and Chief Financial Fitness Trainer at Bissett Financial Fitness. Each week, Tracy's going to tell you what you need to know now at the beginning of your earning curve. Basic and advanced financial concepts made clear, healthy money habits and the missteps to avoid, and all the stuff that you can do to set yourself up for a future of fantastic financial freedom. Ready to lace up and start this week's financial fitness training? Let's do it, Tracy.
Welcome to the Young Money Podcast. Very excited today. We have David Boldovitch of Bold Financial. Welcome to the show, David.
Thanks, Tracy. Appreciate you having me on.
David holds a Master of Industrial Relations from Queen's University and a Commerce degree from Ryerson University. He is licensed to sell life and health insurance products and has extensive experience as a business owner dealing with various corporate structures. Bold Financial is a Toronto-based financial advisory licensed across the country that specializes in helping business owners and professionals thrive. They bring a thorough understanding of financial instruments, insurance products, and strategies that work best for business and career-minded individuals. David believes that great customer service and developing client relationships are the cornerstones of any successful business. His clients often tell him that his attention to detail is unparalleled and that his superpower is his unique ability to take complicated subject matter and break it down into terms that make sense for his clients, as we will hear today. David is happily married to his wife, Ellen, for 14 years. They have two daughters, Jacqueline, 9, and Sydney, 7, which keep him very busy. When not working or acting as a full-time chauffeur to the kids, David enjoys playing hockey, watching movies, and hiking and canoe tripping. Now that I've read your formal bio, I would love for you to share with us in your own words what a regular day and a regular week looks like for you.
Well, my weeks are all over the map, which is really what I love about the industry I'm in. You know, I might start off a morning talking to a business owner about their group benefits or group retirement savings plans, which is a health and dental or sort of pension plan. And then a couple hours later in the day, I might be speaking to a new grad, an optometrist or a dentist or a lawyer about purchasing disability insurance and starting to build a foundation for a plan for the insurance that's going to protect them over the next 40 or so years. The afternoon might be speaking to retirees about their estate or about leaving a legacy to either their family or a charity of their choice. The evening, when I have evening calls, might be speaking to a young couple that just had a baby that want to purchase a juvenile life insurance on the child, which is a great planning tool to give your kids a head start. So my everyday is totally different, and I engage a lot of different challenges, different solutions, different people. It's part of what I love about this business.
Well, I can hear your passion shining through and can tell that you really care about all your clients and helping them with their various needs. So being really focused on them.
It's a great business to be in. It keeps you engaged mentally and emotionally. And there's no shortage of creativity that can be involved in the solutions that we offer. Not only does it allow me to sort of be a master of my own domain in terms of a solopreneur and being a business owner, but, I can choose the clients that I work with. I can be a jack of all trades, or I can specialize. I can also switch things up, whether it's daily or weekly or monthly. It's not a repetitive business at all, which is something that I love about the industry.
Well, that's great. Now, you've had quite a lot of success throughout your career to date. And I'd love if you can share a little bit about your journey and if there's been any key themes that emerged in terms of success factors that showed up repeatedly that led you or propelled you to where you are now.
Well, my journey's been a bit of a wild ride. Life doesn't necessarily go as planned, which is a good thing in my opinion. I graduated from a master's degree in industrial relations and had every intention of moving into labor relations, which is sort of labor law-esque, a lot of collective bargaining, arbitration, mediation type of stuff for big business, representing the companies against in front of the union. But I had an opportunity quickly to run a business on behalf of a distant friend who was expanding their business from Montreal into Toronto. I took that opportunity and I stayed with the company about 10 months until I realized that it wasn't the right spot for me, but it was an incredible learning experience. I went traveling in Europe for 3, 4 months after that to take a break and clear my head and figure out what I was going to do next. And prior to getting back, I was approached by another gentleman to start a business servicing eye surgeons and optometrists throughout Canada. I thought it was a great opportunity and got back from overseas and immediately dove in. And the business took off quickly. And before we knew it, we had about 25 employees and 4 offices across the country. We're doing some good numbers and really building a nice entity. And that's what sort of forced me to get into insurance, both on a personal and on a corporate level. I became intimately involved with the tax and estate planning piece of it. I think that I became my accountant's and my lawyer's dream client because I wasn't the type of person, I wasn't the type of person that could just sign on the dotted line. I needed to understand the nuances and the details around these things. And that's when I first developed a passion for insurance planning. So it's funny, but like fast forward a bunch of years, I sell the companies and looking to get back into the workforce after taking a little break. And immediately this was where my mind and my soul, my desire was to be in this space. So, fortunately for me, I think that the passion comes through when I speak to my clients, and they really, they get that I'm being objective, but I'm also I believe in the things that I am speaking to them about.
Excellent. And do you feel like your education prepared you for being a business owner?
Yes and no. I think that the biggest thing that my education prepared me for is being a critical thinker. I look at every situation now where I analyze and I critique critically with my mind. I think that's really important. Having said that, would I have liked to have paid more attention to my accounting and economics and finance and classes that I was in? Yes, of course. A little bit off topic, but I do seminars for new grads, professional new grads, and it's usually about a 3-hour seminar. Includes a dinner, and when I originally got in, I took it for granted that these really, really smart folks would know a lot of stuff that I assumed that they just knew. As an example, how TFSAs work, how RRSPs work, how
So tax-free savings account and registered retirement savings plan for those who are learning all the financial jargon.
Thank you. And I remember one of the first seminars that I did, I had a lot of people looking at me with glazed over eyes. So I rejigged things a little bit. And the next seminar I came in and I dedicated about half the seminar to really, really basic stuff that, quite frankly, I think should have been dealt with in high school for most Canadians, but it's just not the case. And since then, I've actually had a huge difference in the response that I've had from these seminars, because I think people really value the fact that I'm taking the time to get them educated. So I never had that when I was growing up. So and now, as opposed to those glazed over eyes or confused eyes, I've actually got some very engaged individuals who, for me, that's the start of a beautiful relationship that'll hopefully continue post-graduation.
Well, that's wonderful. And certainly that's one of the genesis for Young Money, to help people get the information they need to learn about things in a non-judgment, easy to understand way, so that if you haven't got it somewhere else, that you don't need to be lacking. And so people can consume it at their own pace. So thanks for sharing all that about your background, Dave, because certainly I've heard a lot of really great traits there. Certainly you're very entrepreneurial, you're very curious and detailed, as well as adaptable. That critical thinking that you highlighted is really crucial for everybody going into the workforce in the future, whether you've got your own business or not, because you've got to be able to solve problems and deal with whatever comes at you. So thank you very much for sharing so freely of your personal life. And that gives us a really good transition into why you're joining us today, because you are an expert in insurance. And so I'd love it if you can explain in really plain language for us what insurance is and the purpose of it.
So at its core, insurance is about mitigating risk, about transferring the risk from yourself or your business or your family to a third party, being the insurance company. And there's different types of products, which I'm sure you're going to ask me about over the next little while. But what has happened and how insurance has evolved is there's sort of two aspects to it. One is the mitigating risk, protecting your family against, unforeseen circumstances. The other aspect is because insurance involves so much tax exemption, insurance really bypasses almost everything to do with tax. People have started to use insurance as a tool to defer tax, to move money from buckets that would otherwise be taxable into tax-free buckets. And that's where things get a little bit more interesting, both on a personal and a corporate level. But at its core, it's about mitigating risk. And then once you've solved or addressed that risk mitigation, then there are often opportunities that can be leveraged if you have the desire and the time to spend on that exercise.
Okay. And the reason people should care about it, I mean, you mentioned one already, but certainly protecting their family. And as we will get into, there's some insurances that you do need when you're living, and there's some that you need when you're deceased to cover off different things that will go on. Is there any other big purposes why people should care about it?
I always say that everyone's wired differently. Yeah, I can speak to two families in identical situations, and sometimes the outcome or the recommendation is actually different because they have different goals or different needs or different values. So when you ask me that question, obviously you want to make sure that your family is okay. You also might want to make sure that the next generation is okay. So we can talk about risk mitigation. We can talk about transferring wealth. And there's different levels of okay. I could take those two scenarios where, let's say we're talking about life insurance, which is a product that pays out in the event of one's death. And one family might say, oh, just look after the mortgage. My family will be okay. And the next family.
And so just to put it in super basic terms, you would take out an amount of coverage that would be sufficient to pay off the mortgage. So nobody would have to worry about that debt when the breadwinner has passed away.
Exactly. Okay. And in the second family B, let's call them, might be in a situation where their philosophy or their feeling on it is, if something were to happen to me, I don't want to just wipe the mortgage. I want to look after my spouse's salary for the next 2 years. I don't want them to even think about working. I want to look after my children's post-secondary education, at least their undergrad. And most importantly, I want to look after what I would have brought to the table for foreseeably, depending on the age of the children and the amount of the mortgage, et cetera, foreseeably for the next 20, 25 years. Because as an example, if I were to pass, I'm 45, I have young children at 9 and 7, as you said earlier, no guarantee that my wife finds another partner. And even if she did find another partner, no guarantee that that person can earn to the same level that I can earn. So I want my family, at least financially, in a better situation than they are now. I don't want my wife to have to think about money. Quite frankly, in my case, again, I'm on the conservative end. I don't even want her to even have to go back to work unless it's an optional choice for her. So, I have a considerable amount of coverage in place because those are my values. Those are my desires.
And you have the means to pay for it.
And as we get into some detail, you'll realize that contrary to popular belief, life insurance is specifically term insurance, which is what we call a rental, as opposed to permanent insurance, which I refer to as owning. Term insurance can actually be very, very inexpensive. But we may get into that a little later in the call. I don't want to jump into it now if you're not ready for it. So,
yeah, well, why don't we start thinking through different ages, the different kinds of insurance people might acquire. So let's start with our listeners. We've got young money listeners.
Okay, so I would say that most people come in.
Sorry, the ones who are in the younger bracket versus their parents or grandparents who are also listening, and young money listeners.
So I would say that most often, if a young professional is, about to graduate from school or has recently graduated, usually the first thing that I end up talking to them about, and again, I'm generalizing because it's always case by case, but the first thing I end up talking to them about is disability insurance. And, I really don't like how the insurance industry has marketed all of their products and names. They're really, really, really behind. Most of the names that they've given to all their products are quite frankly horrible. I refer to disability insurance, which is, can be a confusing term, as just income replacement insurance.
So I get hurt and I can't work anymore. I would rely on that.
Yeah. So, and the thing to note with disability insurance is that it is not based on a diagnosis. Okay. It has nothing to do with being diagnosed. It has simply to do with, can you work? And if you can work, you will not be paid. And if you can't work, you will. And when I say be paid, I mean this is a monthly benefit that would be paid to you each month on a tax-free basis. And that's what you would collect. It's like a paycheck from the insurance company if you cannot work to earn a living on your own. Okay? So most of the time, let's refer to it as a young professional or a new grad, that's the first thing that I urge them to consider purchasing, and certainly to explore, to understand the product. And the reason being is that a young person, again, generalizing, most of the time at that stage in their life, they don't have any investment capital at that point. Most of them are quite frankly in debt. They've taken out student loans, yeah. But what they do have is human capital. And human capital is them and their ability to earn an income, let's say over the next 40 years. So that, combined with the money that you've invested in your education at that point, are the reasons why we want to ensure the individual and their ability to earn an income. I often have a chart that I show to new grads that says, if you're 25 or you're 27 or you're 29 and you plan on earning, $100,000 a year, and let's adjust that number based on, 2% inflation annually compounded, what your lifetime income would be up until age 65. And you'd be surprised, that number can easily be, and when I'm doing it with optometrists or dentists or whatnot, that lifetime income can sometimes be $15, $20 million. And that's a big number that we want to protect, because that's potentially, if you were disabled and you couldn't work for the next 30, 35, 40 years, that's a big, big number that would otherwise be coming to you and your family that is no longer coming. And, it's easily addressed at a reasonable cost if it's addressed at a relatively young age.
Yeah, because you should be, as soon as you start working, you're going to be the youngest and healthiest you can be. So the best time to get it.
Not to mention that in particular for disability insurance, there is a new grad discount that generally applies to most professions. And it's typically to between 15 and 25%. But the 15 and 25%, yeah, it's significant, and it's in perpetuity. So it never, when it comes to disability insurance, at least for what we call professional series contracts, there are only 3 companies in Canada that offer this type of protection. I don't want to get too tactical here, but those companies are Canada Life, RBC, and Manulife. And when you purchase a policy, let's say at age 27, and I quote you a price of X, that X is locked in and will never, ever, ever change until age 65. And the terms and conditions of the contract can never, ever, ever change until age 65. So it's a real opportunity to lock in while you're young and healthy, and know that the rates are already 15 to 25% discounted through that new grad promotion, which is typically only available for 12 months post-graduation. So that's the number one thing for most professional new grads. Now, of course, I said that was generalizing. If you were a mature student, or, you had a spouse or a child, or you had already purchased a home and have a mortgage, then I think it goes without saying that life insurance discussion comes into the picture. So there's a distinction here to be made, as you referred to earlier, Tracy. The disability insurance and another type of insurance called critical illness insurance, which we might talk about afterwards, are what I refer to as a living benefit. Life insurance is a different story. This is a benefit for somebody else. Let's face it, if a life insurance policy pays out, or your loved ones, or a charity of your choice, or whoever might need a lift or might need to look after liabilities that you had left behind. But nonetheless, it's a benefit that would pay out when you are gone.
Hey there, entrepreneurs. Is this episode inspiring you about your business? Are you thinking about starting one from scratch, or are you thinking about taking yours to the next level? I know in any situation, managing and understanding the cash flow in your business is absolutely critical. To help you learn those skills, I've developed the Cash Control Bootcamp, which is an introductory live online group program that empowers entrepreneurs just like you to demystify your business finances and get control of your money. That's going to allow you to sleep better and provide the lifestyle that you want for you and your family. The Cash Control Bootcamp, Know Your Numbers, Protect Your Business, and Grow for the Future is absolutely for you, and it's powering this episode. Check out the link in the show notes to get registered today. Yeah, it's really important to think about that distinction, because you've got to think about yourself when you're living, what would you need? And then when you're gone, who do you not want to have to worry about anything that you might be leaving them?
When it comes to life, when I say life, I mean life insurance. The easiest place to start, where most young people will begin, is with term life insurance. And what term means is just rental. And you can rent for almost any period of time you like. It used to be that there were only term 10 or term 20 rentals, which meant you rented for 10 years or 20 years. Now, quite a number of companies do up to 40 years. And they don't do it in sort of an interval where it's 10 or 20 or 30. They actually allow you to pick any term you want. So if somebody wanted a 27-year term, we would do that. That would be a very specific ask, but the point is we can do whatever we like. The reason why term insurance is surprisingly inexpensive is because if you think about it from a statistical standpoint, I read this about a year ago, every amount and every term policy that's purchased, regardless of age, whether it's 25-year-old or a 60-year-old buying it, statistically in the industry, only 2% of those term policies actually pay out. 98% of the time, it's the insurance company collecting those premiums and never making a payout because the term eventually comes to an end. So, on the one hand, people are thinking, wow, the insurance companies are real crooks. They're collecting all that money, But on the other hand, the reason why the rates are generally pretty low is because the insurers also know that there's a very low probability of them paying out that death claim.
Yeah. Versus the kind of insurance you talked about, the permanent, like owning, probably it's the reverse, 98% payout. And then there's probably some people who don't pay their premiums, but probably the complete reverse.
I would actually say as long as people do pay the premium, it pays out 100% of the time, right? Because it's there forever. So that's why there's a gross difference in the cost. And what ends up happening is that most young people will start with a term policy. And just to give you an idea, like somebody who's in their late 20s or early 30s, for $1 million of term 10 coverage would probably cost, assuming like healthy standard rates, would probably cost in the neighborhood of $25 to $35 a month. Okay, so we're not talking about a huge sum of money. It's very, very reasonable. A term 20 policy for 20 years might cost $35 to $40 a month at that age.
Which, when you think about it, is like less than your gym membership.
Absolutely. But they also look, for most people, the odds of somebody passing between 25 and 45, let's say, is pretty low, right? What I've been urging a lot of people to do of late is to, if they have the desire and are willing to spend a little bit more, is to put a longer term solution in place today that will cover them presumably over the next 40 years and possibly even later into their elderly years. And what I've done, just as an example, is let's say I'm speaking to a young professional. Let's say they're married, they have a child on the way, they've got a decent sized mortgage, and they realize that they've got to protect the spouse for the mortgage and leave some income replacement insurance for the monies that they would have been earning over, in their case, let's say 10 years. It might be a little bit low, but let's assume that we come to a number that we need, just for easy math, we need $2 million of coverage. I often ask people, I say, do you need $2 million forever? Do you need $2 million until age 60 or 65? And the answer is always, no. Why would I need that much at that point? My mortgage is being paid off. My children are growing up. My savings have been increasing. And let's face it, I have, and my spouse has fewer years left ahead of us until life expectancy. So presumably the amount that you need in place will, for most people, will reduce over time. So I say, let's implement a laddered or a tiered strategy today and lock in a lot of this coverage at the lowest prices possible while you're young and while you're healthy. And I might in that case suggest, let's do a term 10 for 500,000. Let's do a term 20 for 500,000. Let's do a term 30 for 500,000. Let's do a term 40 for 500,000. And it's actually a very nice solution. The numbers are different in every scenario. I'm just using this as a generic example, but the idea here is that you only pay for as much coverage as you need for as long as you need it for. Because if you went out and got a $2 million policy for a term 40 from day one to day, that would cost a lot more than tiering it as a 10, a 20, a 30, and a 40. And you're just paying for coverage you don't need.
Mm-hmm. Yeah, that makes sense if you match up what you need based on the different milestones you expect to have in your life and the needs around them. It allows you to conserve funds and still be protected in case that worst case event happens.
Exactly.
Now, you did raise it around critical illness, and I would like you to tell us what that is and why it's important. It's one that I know a lot of people don't know about, regardless of age. And I think that it's important to get it in place when you are young so that you do have that protection, because you don't really know what's going to happen. So why don't you tell us what that is and why what it does and why it's key?
So let's start off quickly just with a definition. A critical illness policy is one that will pay out based on diagnosis, not based on your ability to work, but actually based on diagnosis. And what it does is it pays a tax-free lump sum. So the top three conditions that 85% of the critical illness claims come from are cancer, heart attack, and stroke. The remaining 15% come from another 25 or so conditions that are less likely to affect one. For critical illness, what's key here is that it's just a bag of money that's dropped in one's lap that can be used for anything you like. So the examples that I use are, if you have something really serious or traumatic and you were in a wheelchair and you needed to renovate your home, you've now got that money to install ramps and put in lifts or an elevator. If you didn't want to wait long waits in the medical system and you wanted to drive across the border and get treatment more quickly, you've got cash to do that readily. Another example.
Yeah, I never thought of that one. I mean, I have two, my brother and a close friend of mine both had, one had heart attack, one had cancer, both like in their 30s, so not very old. And they fortunately did have critical illness policies. Fortunately, they both recovered very well. So they were able to take those lump sums and basically do whatever they needed. So one renovated his bathroom and his kitchen, and then my brother used it towards his children's education. So great that they didn't need it, but it was there for those things that you just talked about.
And look, in some cases, it's getting somebody out of dire straits, right? And in other cases, it's just, I've had people that have used the funds to take a holiday and invested the rest. I've had funds where I had a client who approached their mother and said, will you take a 6-month leave of absence from work? I'll replace your income, but come take care of me. Lots of different, look, having
gives
that,
you options.
Yeah, it doesn't solve the problem, but let's face it, in a bad situation, it never hurts to have a bag of money dropped in your lap.
No, I don't think anybody would disagree with that.
Yeah. So, and the other thing that I got a lot of questions about, should I buy critical illness or should I buy disability? The answer is that it depends, and it's not one or the other. They're really designed to complement one another. Disability insurance is going to keep the lights on. It's going to keep the monthly check coming to look after, hopefully, the mortgage, the heat, the hydro, the food, the car, etc. But again, the reality is that if you're in a bad spot, oftentimes you need a lump sum to do more than keep the lights on. What if you needed 24-hour care, or you wanted a nurse in home or something like that? You're going to go back, assuming you have the means, you're going to go backwards in your savings. So that critical illness policy just allows, it's a nice cushion. If a young professional was saying, I can only do one, I would probably say disability, and 99% of cases, because it's more important to have that long, like you can imagine if you were collecting a paycheck every month versus a one-time lump sum on critical illness, again, depending on how long the disability were to last, but in all likelihood, the value of the claim would be far higher with a disability policy than a one-time lump sum on critical illness. But again, they complement each other beautifully.
Is there? We're getting near the end, so I would like to know if there's any other important insurance that we should talk about, or if we should move on to some misconceptions or things that people just have kind of confused about insurance.
So when it comes to permanent insurance, this is the piece that is not a rental. It's when you own. And obviously, if someone has a desire to have coverage in place for the long haul, for the end of the day, even when that's potentially age 100 or beyond, then we're talking about permanent insurance. But what we haven't touched on thus far is that there is an investment piece involved in both types of permanent insurance. We won't get into that today. The two types of permanent insurance are called whole life and universal life. And that's a conversation definitely for another day. I can do several hours on each of those topics. But there is a piece there that allows investments to grow on either a tax deferred or tax exempt basis inside those policies. And that can be an extremely valuable tool for both business owners who, potentially own these policies corporately, but also for individuals who have done well with their planning and are in a position where they've maxed out their RRSPs or their tax-free savings accounts or their children's RESPs. This becomes an incredible vehicle to invest money in, where you can essentially shelter and pay minimum to no tax on these investments. So again, I'll leave it there on permanent insurance, but there are opportunities there to leverage. And the nice thing about permanent insurance is that when you have rental, you have a contractual right in your policy to be able to convert into a permanent product. And I know that's getting a little bit technical, but as an advisor, we're always concerned about the ability for our clients to qualify for coverage. If you have a contractual conversion right, your health is no longer an issue. You are able to convert to that product without needing to medically qualify to obtain it.
And so the reasons people would want permanent insurance beyond tax sheltering of investments, it's really to handle then those needs at end of life in a really good way. So like an example I'm thinking off the top of my head would be to pay any kind of tax liability with passage of, say, a cottage or something at the person's death.
And even, on a smaller scale, looking after a funeral. The example that I use for many situations is even in positive scenarios where there's value in the estate and there's money there, it takes time for an estate to settle, and everything becomes part of probate, as you know. What's nice about an insurance policy is that not only is the benefit tax-free, but it avoids probate altogether. So in most situations,
provided, what's the caveat on the beneficiary there? We want to make sure everybody hears.
Provided that the premiums are paid with after-tax dollars.
Yeah, and that the beneficiary is a named person versus their estate, right?
Yes, absolutely. The rule of thumb is with any insurance product, by the way, is that if you pay with after-tax dollars, then the benefit is tax-free. As an example, not to go back to disability insurance, but if you were to expense your premiums as a business expense for disability coverage, in the event that you needed that coverage, your monthly benefit, the amount that you receive each month, would then become taxable. So it's never advisable to pay those premiums with before tax dollars and write them off or expense them. It's always advisable to pay those premiums with after tax dollars.
Good. Very good tips. So everybody can focus on that. Now, I'm sure during the course of all of your conversations with the various people and business owners that you hear a lot of things that people just have confused, or they have some myths in their mind about insurance that they believe to be true. What are a couple that you'd like to clear up for people today?
Well, I think first and foremost that it's expensive. It can be expensive if you think about purchasing it in later years, even into mid 40s and late 40s, it can start to add up. But when you address it earlier in life, it's actually quite inexpensive. I think another myth is that insurance companies don't pay. In my experience, they absolutely pay. They're in the business of paying claims, and they know, quite frankly, that paying a claim is their best source of advertising. Think about it. When a friend gets sick or when a friend receives the benefit from a critical illness policy, there's a very high likelihood that if you don't have critical illness, that you might be going to approach your insurance advisor and inquire about a policy like that. So they're in the business of paying. They just want to pay in accordance to the terms of the contract. So in this day and age, I hear these ads on the radio every morning when I'm in the car about mostly employer insurance company kick you off claim, your employer threatening to fire you, call me so and so. I can fight and get you money. I think it's important to note that first off, by and far, those scenarios are group long-term disability scenarios. They're not individual disability insurance policies. So that would be coverage that you would have obtained just as from your employer as part of being a member of their health and dental plan. And that level of coverage that's involved in those group scenarios is a completely different animal than a private disability policy that one would own. But the reason I bring this up is because there's a misconception that insurance companies are constantly fighting to get out of paying claims. And I just don't believe that to be the case. I find for the most part, they're actually quite fair. They want their T's crossed and I's dotted, but they pay absolutely when they're supposed to pay.
Excellent. Well, I think that gives us a couple of things to think about. And I'm sure some of the listeners are checking their preconceived ideas around insurance. So before I let you go, I would love it if you can share any final pieces of insight or anything that you've already mentioned that you think is just so critical that you want to reinforce today.
We could be here another half hour. I would say just high level, when it comes to insurance policies, regardless of what living benefits or life insurance or different types of any product, quite frankly, I would urge people to do some homework, get educated, ask a lot of questions. Don't rely entirely on the internet or what you can find out there, because it's like, I deal with a lot of professional grads. I've got many optometry clients, and when the optometrists start asking me crazy detailed questions, I'm always happy to go into the details, but I say to them, this would be the equivalent of me trying to learn what you know about eyes that's taken you 4 years of full-time schooling to learn, right? So ask the questions, get educated. More importantly, vet the advisor that you are planning to work with, and then put your trust in him or her. Let them do their job and let them give you good advice. And they should be asking you lots of questions to determine your situation so they can make proper recommendations. The other thing that's worth noting is that when it comes to insurance products, the price is the price is the price. And what I mean by that is if somebody says, hey, you need $1 million of term 10 life insurance, whether you live in British Columbia or you live in Newfoundland, down to the penny, the price is the same regardless of where you buy it and who you purchase it from. So I wouldn't worry about looking to get a deal or a discount or a rebate or anything like that, because quite frankly, they don't exist. The insurance companies control the costs, and no one is entitled to give a break on that cost. Where your energies should be focused, in my opinion, is in finding that right person that you can trust and that you click with, that relates to you.
I think that's really important. And we talk about that a lot on Young Money, that you should always be dealing with people that show you respect, that are able to answer your questions, that you can understand what they're saying, and that they're giving you what you need. And so you might need to meet a couple of them to find the right one for you. Always asking friends or family for referrals is a great thing, because you probably would be happy with the same person, but don't hesitate to talk to a couple different people, as Dave said, to find somebody that you click with.
Yeah, and sometimes it is a family friend, and sometimes it's somebody you need at arm's length. I have friends that have approached me and said, "Of course, I want you to be my advisor. Who could I trust more? I want you looking out for me." And I have other friends that I'm equally close with that have said, Dave, too close. I need somebody at arm's length. So, and you have to respect that everyone's different.
And so before I let you go, what are you working on now? And if the listeners want to reach out to you and learn more about you and Bold Financial, how can they do that?
Well, easiest way to get a hold of me is through boldfinancial.ca. All of my contact information is there. I can be reached at david@boldfinancial.ca via email if anyone has questions or wants to set up a call. These days, video conferencing is very, very popular. As far as what I'm working on, I continue to work on lots of stuff. I'm heavily involved in group benefits, so I'm constantly dealing with business owners and doing consultation, not only with their health and dental plans, but also with their group retirement savings plans. I'm involved with a couple of the professional schools, and it's currently end of March, which means graduation is fast approaching. Usually by the time May, June, July come into the picture, I'm speaking to dozens and dozens of new grads in different vocations, predominantly talking about disability insurance. I'm always working in the family market to help moms and dads, mitigate the risks that are associated with their families and their mortgages and their children. And then, of course, business owners, which is the bread and butter of my practice, and helping them plan and put their retained earnings, the monies that are kept behind in their businesses, to good use for future planning.
Excellent. Well, thank you so much for joining us today, Dave. I know I'm taking away a lot, as I'm sure the listeners are. So really, you did a great job of explaining what insurance is so that we can get a feel for it. Around life insurance, you did a great job explaining the different kinds, what we should be thinking about, how we should consider it. And then certainly around the young professionals who may be listening, really clarifying and spelling out for us the differences between disability versus critical illness. Really liked how much you shared about your career path and all of the different things that have led to your success, because as we know, there's no one way to success, and your success traits really showed through and has led you to where you are today. So thank you so much.
My pleasure. Thanks for having me, Tracy.
Hey, thanks for tuning in. To all you millionaires in the making out there, if you love this podcast, please subscribe on iTunes to keep your financial fitness training going. Oh, and leave us a review. And be sure to visit Visit, 2 S's, 2 T's, financialfitness.com to take your free financial fitness assessment. Find out how financially fit you really are. See you next week, young millionaires to be.